Welcome to this another presentation relating to the 2012 superannuation update for SMSF trustees. My name is Melvin Holsworth and I am the principal here at Holsworth Law and Associates. As usual, we have to normally put our disclaimer up letting people know who are watching this that this is general advice only and it doesn't take into account your specific circumstances. Also remembering that the SIS and tax laws are ever changing, so you need to seek specialist advice on a timely manner before making any decisions relating to your financial future. Also, in regard to this presentation, it is a very much watch this space because it is based upon the budget presentation and it hasn't gone to legislation yet. So this section, this presentation deals with the 30% contributions tax for those earning an adjusted net income of $300,000 or more in the financial year 1 July 2012 to 30 June 2013. It forms one of the 7 presentations that I've done on contributions, and I would invite you to view the other presentation so you can have the full gamut of what is happening in this space for self-managed superannuation funds. And so let's get into this. Okay, so just be aware that this has just come down in this year's Gillard Government May budget. It has not been legislated as yet, but it has a start date of 1 July 2012. I wouldn't at all be surprised if some changes come through from what we were given in budget papers and pre-budget papers and the announcement on the night. So let's just work our way through how all this works. So from the 1st of July 2012, individuals with adjusted net taxable income that exceeds 300k will pay a 30% contributions tax on their concessional contributions. So what is the adjusted net taxable income? Well, it's the net taxable income, and then you add back any rental losses that you may have deducted to form part of your taxable income, or any other gearing losses. For example, you may have invested in a share portfolio and it's geared and it came out with some losses. Then you add on to that amount your reportable fringe benefits, which is on your PAYG certificate from your employer, and you also add on your reportable superannuation, which is likewise on there. The reportable superannuation is that amount that you have salary sacrificed into superannuation. It is not the mandated 9%. And then you take away from this amount any child support payments made. So the 30% tax is calculated to be levied on that amount of the reportable superannuation and mandatory superannuation, which forms part of that above calculation. Now that sounds a little bit complicated, so I guess the best way to explain it is through a couple of examples. So example 1 has me, Mel, earning a gross salary of 280k as on my PAYG annual certificate, or the group certificate as some of the oldies might know it. He also has reportable FBT of 50,000 and also salary sacrificed another 50k, which is also showing as reportable superannuation on the PAYG. Also, my tax return has got 2 rental properties that are heavily geared, and so I had some losses on these of 50k, and I had normal tax deductions of $6,000. So let's have a look at the table. So the table shows a gross income of 280,000. Take away my rental loss of 50k and take away my other deductions of 6,000 to bring me back to a net taxable income of 224,000, and that's what my tax return would show, and that's what my tax assessment would show from the ATO. But to get to this adjusted salary, I then have to add back that 50,000 of rental loss. I add on my reportable fringe benefits. I also add on my reportable super to bring me up to an adjusted taxable income of 374,000. Might I add, this adjustable taxable income of 374 is also used for the repayment of any HECS debt or student loans, and it's also used for the repayment for the calculation of any Medicare levy surcharge. So the government has grabbed that definition, that higher definition, which came in the May budget 2011, and is also using that same calculation for now this 30% contributions tax. So back to the example, we've got an adjusted taxable income of $374,000. So if you have a look at that example, the whole $50,000 that I had put into superannuation as salary sacrifice is above the $300,000. It forms part of that $74,000 which is exceeding it. So the whole $50,000 will be taxed not at 15%, the normal rate for self-managed super funds, but at the higher rate of 30%. Next example. Mel, in the same circumstance, only this time I have changed my gross salary down to $210,000. So I've still got the same reportable fringe benefits tax of $50,000, salary sacrifice $50,000, rental property loss of $50,000, normal deductions of $60,000. So once again, we've got $210 on the top line. Take away the $50,000, take away the $60,000 to bring me back to a net taxable income of $154,000. Then I add back onto that $50,000 worth of rental loss, $50,000 worth of reportable fringe benefits, $50,000 worth of reportable super to bring me up to an adjusted taxable income of $304,000. Now, as you know, the threshold is $300,000, so the excess is $400,000. So the excess, is $4,000. So $4,000 of the $50,000 of the reported fringe benefits, of the reportable superannuation, I should say, $4,000 of that $50,000 will be taxed at 15%, at 30%, not at 15%. So the actual tax on that $4,000 is $1,200. Now, if it wasn't for this legislation, that whole $50,000 would be taxed at 15%. But in this instance, you can see $46,000 is being taxed at the lower concessional rate of 15%, and the $4,000, which is the amount that exceeds the $300,000, is actually being charged at 30%. So in this example, the extra tax is $600 over the norm. If in another example that the concessional contributions exceeded the cap, i.e. for the current financial year we're in, $50,000 for those who are over the age of 50, and also the adjusted net taxable income also exceeded the $300,000, then the 30% tax rate would not apply, as the excess contributions tax would apply, and the tax commissioner would levy excess contributions tax, and that creates for him a greater revenue stream. He's graciously decided not to charge both taxes, but given way to the higher rate of tax, which is contributions tax. What we're unsure of is who is actually going to pay the extra 15% tax. It'll also mean that when we're doing, if they come up with the fact that the actual superannuation fund, which is the most, which was what we would expect, that the superannuation fund pay the extra 15% tax, how will we know what you as members, what your earnings are for the year? We don't know what your net taxable income is or see any of the details of your personal tax returns. So we don't know how to accrue the tax in the superannuation fund. This is just stupid legislation, and it adds, confusion and uncertainty to what is already a very complicated area. The superannuation sector is already heavily regulated, and this further impost, coupled with reduction of contribution levels, which I pointed out in another area, just may push some away from superannuation altogether. That would be very sad. This measure undermines the confidence in retire income streams. Arguably, this measure is pointed towards individuals who are at the peak of their earning capacities and who may not have been able to adequately save for retirement in the past due to broken working patterns. This is especially significant when coupled with the government's budget measure to defer the increase in concessional cap for individuals over the age of 50. And so I'm a little bit concerned that this is a further disincentive to individuals in Australia being self-reliant in their retirement. Thank you very much.